Welcome to Stocks, Bonds, and Cash. This is the SafeSimpleSound podcast, where our S3 approach to financial planning creates both end solutions for the contradictions families face. I'm speaking with you today, drawing from our team's chartered financial consultant background and our S3 framework development. In today's episode, we're exploring the three core building blocks of any investment plan: stocks, bonds, and cash. This is the same topic we recently wrote about on our blog because we've found that so much financial anxiety stems from a simple misunderstanding of what these assets are designed to do. Whether you're just starting to invest or you've been managing a portfolio for years and still feel a little uncertain about the why behind your decisions, this episode will give you a clear and durable framework for understanding your investments. We'll achieve this through our safe, simple, sound approach to building a portfolio that is resilient, understandable, and aligned with your family's deepest values. Many families we speak with through our safe, simple, sound practice feel caught in a classic financial contradiction. On one hand, they hear they need to take risks with their money to see it grow and outpace inflation. On the other, they hear warnings about market volatility and the danger of losing what they've worked so hard to save. This creates an either-or trap. It feels like a choice between two bad options: gamble on the stock market for growth, or hide in the perceived safety of cash and watch your buying power slowly fade away. This tension can lead to paralysis, where making no decision feels safer than making the wrong one. The traditional financial media often fuels this dilemma. You'll see headlines pitting stocks against bonds as if they are rivals in a zero-sum game. This framing is fundamentally flawed and misses the main principle at the heart of sound investing. From a safe, simple, sound perspective, the solution isn't to pick a winner between growth and safety. It's a both-and solution. It's not about picking the single best player. It's about building a championship team. Think of your portfolio like a well-coached sports team. To win consistently, you can't just field a team of star strikers who only know how to attack. You also need solid defenders to protect your goal and versatile players on the bench, ready to step in when needed. Each player has a distinct and vital role. This is the foundation of a durable investment plan. Each asset class, stocks, bonds, and cash, has a specific job to do. Understanding these jobs transforms confusion into clarity. This approach aligns perfectly with our S3 framework. It's safe because by having different players with different roles, you build a portfolio that can handle different economic seasons. The stability from one asset class provides the psychological safety to stick with your plan when another asset class is going through a tough period. It's simple because the team analogy is intuitive. You don't need to be a Wall Street analyst to understand the difference between a striker and a defender. It's a mental model that makes complex financial strategy immediately accessible. And it's sound because this principle of diversification and asset allocation is one of the most time-tested, evidence-based strategies for long-term financial success. It's a systematic way of balancing risk and reward. So, let's meet the players on your financial team. First, we have your star striker. Equities, more commonly known as stocks. When you buy a stock, you're buying a small piece of a publicly traded company. You become a part owner. The primary role of stocks in your portfolio is to score points, to generate long-term growth. They offer the highest potential for returns over time. This growth happens in two ways. First, through capital appreciation, where the value of the stock itself increases, and second, through dividends, where the company shares some of its profits directly with you as an owner. Now, because strikers are focused on offense, they are more exposed to risk. In investing, this is primarily what we call market risk, the natural ebb and flow of the broader market that can affect even the best companies. There's also business risk, which is tied to the performance of the specific company. But despite this volatility, stocks are the indispensable engine for long-term growth on your team. Next, let's talk about your steady defenders. Fixed income, or bonds. If stocks are about scoring, bonds are about preventing the other team from scoring. A bond is essentially a loan you make to a government or a corporation. In return, they promise to pay you regular interest and then give you your original money back at a future date. The primary role of bonds is not dramatic growth. It's stability and predictable income. From a safe, simple sound viewpoint, this is a crucial element for creating psychological safety. Bonds are the shock absorbers. When the stock market is turbulent, when your strikers are having a bad day, your defenders are there to hold the line. They are generally less volatile and often move in the opposite direction of stocks, providing a steadying influence that helps you stay committed to your long-term plan. The risks here are different, mainly interest rate risk, which affects the market value of your bond, and credit risk, the small chance the issuer can't pay you back. But for the most part, high-quality bonds are the component of your portfolio that provides peace of mind. Finally, every great team needs a deep bench. This is the role of cash and money market securities. These are your versatile substitutes. Think high-yield savings accounts or money market funds. Their job isn't to score big points or make dramatic defensive plays. Their role is threefold and critically important. First is safety. The dollar value of cash doesn't fluctuate with the market. It's your safe haven. Second is liquidity. This money is immediately available for emergencies or planned expenses without you having to sell your other investments, potentially at a bad time. Third is opportunity. Holding some cash gives you what's often called dry powder. It allows you to be strategic, to put a new striker on the field when there's a great opportunity, like during a market downturn. The quiet risk to cash is inflation, the gentle, steady erosion of its purchasing power over time. $1 today won't buy as much in 10 years. That's why the bench is important, but you don't want your whole team sitting on it. So you have your strikers for growth, your defenders for stability, and your bench for safety, liquidity, and opportunity. It's not a competition, it's a collaboration. That is the insight that transforms investing from a source of anxiety into a source of empowerment. To illustrate this principle in action, this shift from picking a winner to building a team, let me share a hypothetical scenario that demonstrates patterns we see in our practice. Consider a fictional couple. We'll call them Mark and Sarah. They are in their early 50s and have been diligent savers. Mark has worked for a successful tech company for 20 years, and a significant portion of their net worth is tied up in that company's stock, which they received through employee stock plans. Sarah, being more cautious, has insisted they also keep a very large amount of cash in a standard savings account at their bank. Mark and Sarah feel stuck in that classic either-or trap. Mark sees the incredible growth they've had from the company's stock, their star striker, and is hesitant to change anything. Sarah looks at that same stock and feels immense anxiety. She knows their future is tied to the fate of a single company, and she worries about what would happen if the company or the tech sector went through a difficult period. Her solution is the pile of cash, but she's also frustrated because she knows it's earning next to nothing and isn't really working for them. Their portfolio is all strikers and bench players. There are no defenders. They have a team built for extremes, but not for consistency. Through the lens of our Safe, Simple Sound framework, the first step isn't a radical decision, but a shift in perspective. The goal is not to declare Mark's approach right and Sarah's wrong, or vice versa. The goal is to build a structure that honors both the need for growth and the need for security. It's a both-and solution. So in this educational example, we would begin by defining the roles. We'd ask, what is the job of each dollar you own? First, we'd look at the cash. We would help them allocate a portion of it to its proper role on the bench, an emergency fund for 6 to 9 months of living expenses, plus funds for any large planned purchases in the next couple of years. This is its job, safety and liquidity. The excess cash, however, is an unemployed team member. It needs a job. Next, we'd look at the company stock. This has been a fantastic star striker, but it's just one player. A team with only one striker is vulnerable. Drawing from our CHFC background at Safe Simple Sound, our approach suggests diversifying to build a full offensive line. In this hypothetical, Mark and Sarah might systematically sell a portion of the single company stock over time to manage taxes. They would then use those proceeds to hire a team of strikers, a diversified portfolio of global stocks across many different companies and industries. Their growth engine is now much more robust and less dependent on a single player's performance. Finally, we address the missing piece, the defenders. Some of the proceeds from the stock sale and the excess cash from the savings account could be used to acquire high quality bonds. This introduces that element of stability and predictability that was completely absent from their plan. These bonds are the defenders whose job is to hold steady and provide income, especially during times when the stock market is volatile. Now, look at the transformation. Mark and Sarah no longer have a portfolio of extremes. They have a balanced portfolio. They have a team of diversified strikers, global stocks for growth. They have a team of steady defenders, bonds for stability. And they have a well-stocked bench, cash for safety and opportunity. The conversation is no longer about Mark's risk versus Sarah's safety. It's about our team and how each part works together to move them toward their shared goals. While this story of Mark and Sarah is fictional, it demonstrates how our S3 framework can resolve deep-seated financial conflicts and anxieties. It provides a shared language and a common goal. This example shows patterns we observe when families haven't systematically defined the roles for each dollar in their portfolio. It often leads to one part of their financial life feeling disconnected from, or even at war with, another. Whether you're facing this exact situation with company stock or just have a general feeling of imbalance in your own investments, the principle is the same. The first and most powerful step is to stop thinking about your assets as a random collection and start seeing them as a coordinated team where every player has a vital role. So, let's bring it all together. Today, we've moved beyond the confusing either-or narrative of investing and established a clear S3 both-and framework. Our key insight from a SafeSimpleSound perspective is this. A successful investment strategy isn't about picking the single best asset class. It's about thoughtfully blending them to create a team that works together. We identified the three core players on this team. First, your stocks, the star strikers whose primary role is to drive long-term growth. Second, your bonds, the steady defenders who provide stability, income, and peace of mind. And third, your cash, the versatile players on the bench who provide safety, liquidity, and the opportunity to act strategically. By understanding the distinct job of each player, you can begin to build a portfolio that is balanced, resilient, and aligned with your family's specific goals and timeline. This is the foundation of creating a financial plan that feels safe, simple, and sound. So what is a practical next step you can take after listening to this episode? Here is a simple, empowering action. You don't need to make any changes today. Just open up your statements or log into your accounts and look at your investments through this new lens. Ask yourself, can I identify my strikers, my defenders, and my players on the bench? Is my team balanced, or is it tilted too heavily in one direction? Just this simple act of reframing is a powerful move toward greater clarity and control. This episode draws from our recent blog post, Stocks, Bonds, and Cash. A CFC breaks down the three core asset classes, which you can find at SafeSimpleSound.com for the complete written framework. If today's Safe Simple Sound insights resonate with your family's situation and you feel you might benefit from a deeper, more personalized application of these principles, we invite you to explore what constitutional financial planning could look like through our Safe Simple Sound practice. Either way, you are now equipped with a powerful capability, the ability to see your investments not as a source of confusion or conflict, but as a coordinated team working together for your family's future. That clarity is the first step toward building lasting financial peace of mind. Thank you for joining us today.